In Chapter 6, we will review the profitability and performance of financial firms. That includes banks and other financial institutions. These financial performance ratios are typically on profitability of the institution. So we will be focusing on the income statement more, and then in Chapter 7 we will focus on the balance sheet. We will also define in this chapter what are the key risks financial institutions face, and that includes credit, liquidity, and other types of risks. These will be expanded upon further and discussed in greater detail in the future chapters. Some of the financial ratios that are reviewed by the financial institutions, particularly for the purpose of regulators and shareholders, are the same as those ratios that are reviewed by any corporation. So in this chapter we will make sure that we don't repeat those ratios. We will be selective in the ratios that are specific to financial institutions, given that students have perhaps studied some of the other ratios in other classes. For example, we will not discuss how financial institutions value their common stock. This is the equation that is typically used for all companies. So we will not discuss this. Why do financial institutions review their financial statements and determine the performance? Is mainly because they want to make sure that the return that they are generating on loans and securities that they provide to their clients, or securities that they invest in and loans they give out to their customers, are generating a sufficient return. This equation is not required. This is a more simplistic way of determining the price of a particular company's stock today in year 0. Again, students have studied this in previous finance courses. Again, this ratio is further explaining the determination and calculation of price of the stock, which is a present value of future dividends. This ratio will not be covered. So starting with page number 8, we will review several financial ratios, and again those that are specific to evaluation of financial firms rather than other private corporations. One of the ratios that we will look at is return on equity capital. I'm sure that students have heard the term ROE and ROA, return on assets. Now please keep in mind the return on equity is a ratio that is calculated by taking the net profit or net income after tax divided by total equity capital. However, this ratio is used mostly for non-financial institutions. We will review the return on equity capital ratio, the equation that is required for students to know, that is specifically used for financial institutions, later on in this chapter. Return on assets is net income after tax divided by total assets. The net interest margin is calculated by taking the interest income that institutions earn on loans as well as securities. And we subtract from that interest expense that is paid to depositors who deposit money in an institution, as well as interest expense on borrowings. Institutions borrow money from other institutions, and they have to pay interest expense. So the difference between interest income and interest expense is known as net interest income, and when we divide that by assets, we arrive at net interest margin. So what we will do for the next few minutes, perhaps half an hour, is to look at the key ratios, make sure we understand the formulas, because these are required for students to know in the exam. No formula sheets are allowed. No textbook is allowed. So students must memorize this. We will practice these equations when we go through 2 problems at the end of the chapter. So before we go further, there is a typo in the textbook by the publishers, by the authors, that I wanted to point out. And that typo, that error, exists in 2 or 3 equations. The denominator says total assets square. In fact, this is not square, so we should cross out the 2. In fact, in the textbook, the 2 represents a footnote on that page. And the individual that prepared the slides for the authors included the 2, not realizing that it is a footnote in the textbook. So please note the denominator is total assets, not total assets square. Likewise, for the next equation, 6, 7, the denominator is total assets. So please remove the 2. The non-interest margin, by the way, compared to the previous formula, net interest margin. This equation is looking at the interest income and the interest expense incurred by the institution. Here, in formula 6, 7, we are reviewing non-interest income and non-interest expense. And that students should clearly understand that, please. What is the difference between interest income and non-interest revenue or income? Is the same thing. Non-interest income or revenue are fees that institutions charge their clients, individuals and business clients. There are 2 types of revenues that institutions earn. One of them is interest income, and the other one is fees, which are known as non-interest. We subtract from the non-interest revenues something called provision for loan and lease losses, and we also subtract non-interest expense. Now, the provision for loan and lease losses are related to the investments they have made or loans they've given out. The provision is an allowance for any loans or leases that have been given to customers that potentially the customers will not be able to pay back the bank, and therefore the bank will lose the funds, the money This is very similar to allowance for doubtful accounts that you may be aware of in a normal corporation. We call it provision for loans and lease losses. It is an expense. And again, please keep in mind, it is purely an estimate. And so is the allowance for doubtful accounts. It's an estimate. The bad debts are the actual expenses in a corporation. We also subtract from the net, the non-interest revenue, non-interest expenses. Non-interest expenses compared to interest expense, which is on loans, on borrowings and deposits. Non-interest expense is our operating expenses, salaries, benefits, rent, utilities, all expenses that institutions incur for operations purposes. The interest expense is for money that they borrow or interest they pay to depositors. We divide the total of this, the net of that, by total assets. And that is known as the margin, net non-interest margin. Net operating revenues are essentially combining the two income categories, interest income or interest revenue and non-interest income, which is non-interest revenues, which are fees. So the combination of both revenues are known as total operating revenues. We subtract from that all operating expenses. Operating expenses include interest expense, the provision for loan and lease losses, as well as the non-interest expense. The combination of those three will be total operating expenses. That the result is then divide that by total assets. And you notice the fact that this one does not have the 2 because this formula was in a separate page in the textbook that did not have the footnote. So all these equations we are dividing by total assets. What is not included in the numerator are income taxes that are paid. And therefore, we refer to this as net operating income, which is the net of the 2, but before tax, because taxes are not reflected here. We would divide that by total assets. The next equation, earnings per share, is not going to be covered in the class because students have studied this equation in other classes. Earnings per share is calculated no differently for financial institutions as it is for corporations. So that ratio is not required. This particular page explains, the author is explaining the ratios we just went through and what the meaning of these ratios are. The ROA, the ROE, net interest, net operating margin, etc. We will talk about these ratios when we calculate them. Earnings spread, formula number 10, is a very important equation. It is by far the most difficult equation. Earnings spread is calculating the efficiency by which the financial institution's management is generating interest income, only interest income please, not fees, just interest, relative to the assets that provide the interest income to the institution. So for example, earning assets are loans and securities. So we only include as a new denominator for this part of the equation, the first half of the equation, assets that are earning interest. How does it differ with total assets? Total assets includes all assets, those that earn interest and those that do not earn interest. In this formula, we are only including those assets that earn interest. We will identify those when we go through the problem at the end of the chapter. We subtract that result by looking at the interest expense, which is the other side of the equation. This is the income on loans and securities. These are expenses, interest expense paid on to depositors and other borrowings. We divide that by all interest-bearing liabilities. As we discussed in chapters 1 and 3, liabilities of a particular bank are deposits and other borrowings. So all of those deposits and any loans the banks have borrowed from others, such as a central bank, they do borrow money from through central banks, are all considered as denominator, and the interest expense paid on those are reflected as the numerator. We will then subtract the results to arrive at the earnings spread. Equation number 11. This is a required equation. I wanted to go back to page number 8. You recall that we did not cover return on equity. And I had indicated that this equation to calculate ROE is not used by financial institutions, but it is used, this equation is correctly used by other corporations. Well, what equation does the financial institutions use to calculate the ROE? And that is equation 11. Return on equity is calculated by taking the return on assets times total assets divided by total equity capital. And the total assets divided by total equity capital will be defined as the equity multiplier in one of the future ratios. We will discuss why institutions use this formula to arrive at the ROE rather than formula number 4, although both the formulas provide you with the same exact answer. In the exam, please ensure that no one should use equation 6.4 to calculate ROE. No points will be given to the students if they use this equation, even though your answer will be correct, because institutions measure ROE by taking ROA times total assets over total equity capital. More on this when we go through the example later on. Formula number 12 and 13 as well as 14 are essentially an extension of formula 11. More details there. Each of the components are broken down. Means ROA is net income over total assets. So the author is providing a detail of each of the components, and these are further details. If you feel comfortable understanding and knowing this formula 11, that should be sufficient. So we'll go to formula number 15 next, because formula 14, 13 and 12 are the same as 11 except more detail. So the net profit margin, NPM. The net profit margin is calculated by taking net income after tax divided by total operating revenues. Please note, the total operating revenues, if I can go back to the 2 slides, are interest income as well as non-interest income or revenues, which are fees. So the combination of those two are known as total operating revenues in formula number 6.8. That is the denominator for this equation, and the numerator is the net income after tax, please. Formula number 16 is not required. The asset utilization equation is commonly studied in many other classes because that applies to other corporations as well. So we will skip on that and we'll go to the equity multiplier. Now this is one of the more important equations. It is not very difficult to calculate. It is simply taking the total assets given to you for that financial institution, and we simply divide that by total capital or equity capital to arrive at what is known as the equity multiplier. However, the importance of this equation, although very simple to calculate, the importance is quite significant. Why? Because this equation, total assets divided by total equity, what is now known as the equity multiplier, is used in formula number 611 as part of the component to calculate ROE. Total assets divided by total equity capital. Again, if you go to formula 17, that's exactly what that is. And that is known as the equity multiplier. So therefore, return on equity must be calculated in this course by multiplying the return on assets times the equity multiplier. So this pretty much concludes the equations that we are going to review. I would like to go through some of the explanations of these equations and how do management of financial institutions manage these equations. I will also share with you some statistics as to what are the average ratios that we just went through, some of the ratios for all institutions, as well as the historical trend. And then we will actually move on to calculating these. So this particular equation, this page, is providing a flowchart format of calculating ROE. Return on equity is calculated by taking ROA, which is the net profit after tax, divided by total assets, times the equity multiplier, which is exactly what we defined. Okay. The return on assets represents profits, because one of the components is net profit. How much profit after tax is the institution making on their assets? The equity multiplier represents and provides information to regulators as well as investors and the management of institutions on how well is the company, is the bank itself or the institution capitalized. Do they have enough capital? Capital is cushion. The higher the capital, the lower the risk of the institution. So we are in essence looking at the capital structure. Again, more on this when we calculate that. Here are some good statistics. In this particular page, the author is showing for each of these years, the equity multiplier and the return on equity. Now please note the equity multiplier is total assets divided by total equity capital. Please note the fact that the lower this ratio, the better. Many ratios that we study, we view those ratios as higher the better. In this case, the equity multiplier, lower the better. Therefore, as we move from 1992, throughout the 1990s, the financial institutions became more profitable. The risks began to go down as they increased the amount of capital. So the capital equity amount, which is the denominator, the dollar amount, went up faster than total assets. When the denominator goes up more than the numerator, the result is a lower number. Please note these are not percentages. These are what we call times, axis times. They are relative. So throughout the 1990s, financial firms became less risky because of higher capitals, and therefore the ratio began to improve dramatically. Remember, the lower the better. Same thing happened in the 2000s until we had the financial crisis around 2007, and therefore the equity multiplier, which represents the riskiness of the institutions, increased. So therefore the risk increased. At that point, many of the government regulators across the world did not want the institutions to fail, particularly the large institutions, and therefore the governments invested money in the form of preferred stock in these institutions. And therefore, when outsiders, such as the government, invest money and purchases shares of stock just to provide more capital, the denominator went up. So the total equity capital dollar amount went up, and with total assets remaining the same, the ratio went lower, which is lower the better. So by investing more capital, these institutions improved their equity multiplier. However, those institutions incurred significant losses in 2008, and they continued to incur losses in 2009 as well as 2010. Any net loss from the income statement is reflected within retained earnings, which reduces the retained earnings. Profits will increase retained earnings. Losses will reduce retained earnings. Therefore, retained earnings is a component of equity capital. And therefore, while equity capital went up in 2008 because of investments, that increase did not help the institutions, because the following year the capital went back down because of losses. Retained earnings declined when losses were brought forward to retained earnings. As a result of the lower equity capital in 2009, the ratio went back up mathematically. This shows the return on equity. Please note that return on equity is calculated by taking the equity multiplier times the return on assets. Now we realize we do not have return on assets on this particular page, but the results to the shareholders, this is the return to the shareholders, increased throughout 1990s, mainly because the institution's risk went down. And as the risk went down, the return on assets went up. And the higher return on assets, combined with the lower equity multiplier, still resulted in higher result. So ROA went up much faster than EM going down, and therefore the ratios improved, until we began to see the difficulties during the financial crisis. The profits, the ROA, return on assets, which were profitable, had gone down. ROA had declined dramatically, and therefore the ROE, which one of the components is return on assets, went down as well. The shareholders earned significantly less. 618 and 619 are further breakdown of return on equity. Again, to remind you, students will be required to know formula number 11 for return on equity. You don't need to know the details behind it, and neither do we need to know 18 and 19. So these are excluded. So is formula number 20 is not required. The net interest margin was calculated by taking interest revenue minus interest expense divided by total assets. We studied that already. The total revenues, we subtract from that the expenses, and we get operating profit. The expenses are interest expense and non-interest expense. Interest expenses on deposits and borrowings, non-interest expense are operating expenses. So this equation, all it is doing is actually expanding. If I can take this back, it is expanding on the net operating margin equation as well as the return on assets equation. Again, students are not required to know the details behind it. How does the income statement read for a financial institution? It's rather simple. Please make sure that you review this in the textbook on page number 179, table 6.2. The income statement is categorized here in certain sections. So if we start from the top, we first have interest expense and interest income netted out to arrive at net interest income. When we divide that by assets, it is known as net interest margin. We then look at the non-interest income and non-interest expense further down. So we are marching down this income statement. We first look at the highest revenue, interest income, the highest expense, interest expense, and we take the difference. Now we're looking at the second category of revenue, which is fees and fee income, which is non-interest income. And we look at the next category of expenses. These are operating expenses. And we subtract from that provision for loan and lease losses, which is what you are familiar with, allowance for doubtful account. When we take the net of these three, we arrive at pre-tax net operating income. When we divide that by total assets, we arrive at the pre-tax net operating margin. And then we subtract the income taxes to arrive at net income. Here are some key ratios for all institutions from 1992 to 2009. The one that I wanted to point out to you is the return on assets, which is at the bottom. Return on assets is net income after tax, which is all of these calculated, and this is the bottom line, net income after tax. And we divided that by total assets, so this is a percentage, please. You notice the fact that the ROA increases. It is over 1% pretty much all of 1999 as well as 2000s, and certainly when the financial crisis occurs in 2008, the ratio goes down, and then it goes to negative because of the losses. So the negative 0.36 represents a net loss divided by total assets. So the next couple of slides explains why we review the performance. Shareholders want to know this, regulators want to be aware of this, and the management wants to be also aware of these ratios. The standard deviation, which represents the risk, is not going to be asked in the exam. So you do not need to know how to calculate the standard deviation. That is more of a statistical course. We already talked about ROA and ROE. So that pretty much concludes the discussion on the formulas and equations and ratios. We will practice 2 problems in a few minutes. But before that, I wanted to explain to you what are the key risks that institutions face. Now, these risks are explained beginning page number 182 in the textbook. Here we are only going to define some of these, only the most important ones, and later on in the future chapters we will spend more time on each one of these major risks. The 5 major risks are in order from the top down: credit, liquidity, market, interest rate, and operational risk. The remaining 4 risks are important, of course, but not on an ongoing basis. These risks occur sporadically, periodically, but the first 5 are common risks that could occur for all institutions at any time. Let's define what they are. Now, there are no slides that explains this. Please review the chapters starting with page 182. You could be asked multiple choice questions to test your knowledge on what are these risks. Credit risk is the risk of default. What that means is that loans and securities that the institution has invested in, which are supposed to earn interest income, are not earning interest income. Means the fact that they have become worthless. Why? Because the loan has failed, the customer or the client is not able to pay back the bank the loan that they borrowed, or the securities that they invested in, the issuers have a very high risk. Issuers could be typically government agencies, and as you know, countries like Greece, Spain, Italy, all of these countries were having difficult times 2-3 years ago. And therefore, those securities that were invested in, that were issued by those governments, have become more risky, especially if the institution has that on their portfolio. Liquidity risk is the risk that the institution has sufficient cash. Why is the cash important? Mainly because of the fact that customers could come in and withdraw the deposits at any time. An institution, a bank, a bank or an investment bank or a mutual fund who is holding funds on behalf of the customer, those funds can be demanded by the customer if they want that liquidity. So therefore, these institutions must have sufficient cash available to them. Market risk is the risk that the marketability of some of the securities they've invested in has declined. Why does the marketability decline on securities? So for example, many of the financial institutions had invested in government bonds. Some of the governments were having difficulty, economic difficulties, particularly the foreign governments, and some local government bonds as well, such as the city of Detroit is a good example, which was having financial difficulty. If my bank or institution had invested in bonds issued by the city of Detroit, and if I have those bonds on the balance sheet, the likelihood that those bonds will be worth anything is very, very low, because the city is failing and they will not be able to pay back to the investors what they had invested, and therefore the bank will lose money. Therefore, that implies market risk. Interest rate risk is the risk that the values of the securities will decline if interest rates, market interest rates, were to rise. Most of the securities are coupon interest bonds. They provide a fixed coupon interest by the issuer. So the financial institution, the bank, is earning interest income on a fixed rate basis. However, in the future, if interest rates rise above the coupon interest rate, then the value, the market value, the current price of the bond that I'm holding that is earning a lower rate will decline. So the interest rate risk implies the risk of interest rates going up, and therefore mathematically the value of the bonds decline. Bond prices react inversely to interest rates. If interest rates rise, bond prices falls. If interest rates decline, on the other hand, bond prices rises. If interest rates rise, bond prices falls. So that is essentially the interest rate risk, mainly because these securities are long term. The fifth risk is the operational risk. This is the risk that the financial institution is not paying sufficient attention to training their employees. They don't have very good experience, and therefore the employees are making errors. These errors are expensive because they are customer errors. Customers could be adversely impacted if the employees make a mistake. Okay. Interest rate risk is also the risk that their technology, their computer systems for financial institutions are not secured enough. What that means is that somebody from outside is able to hack into the computers of the financial institution, and therefore they could do a lot of damage by stealing customer data. And this is very secured customer data. And that could be detrimental to the financial institution, especially if the customer's funds are stolen from the bank electronically. So these are the 5 major risks. We will discuss these more in detail. There are also risks associated with compliance, money laundering. A lot of the financial institutions were caught with that in the recent past. That is not complying with government laws. Reputation risk is the fact that the institution's reputation is going to go down if the news is publicizing something that is offensive to the financial institution because they did not comply with the government, or any of these risks are being publicized anywhere, that could destroy the reputation of the institution. Customers will be afraid to leave their money or rely on them to invest their money on their behalf. Strategic risk is the risk that the strategic plan, which is the long-term plan established by the financial institution, is not meeting the requirements, means they are performing below strategic plan. Capital risk is the risk that they do not have sufficient capital or cushion. Again, these are explained more in detail in other chapters. Formula number 21 is not required. We have all studied the productivity ratios and efficiency ratios in other courses. Again, the way we calculate in financial institutions is the same way as we do elsewhere. So I'm trying to focus on only those equations, 7 or 8 equations, that are rather unique to financial institutions. So this page is not required. These are what author is doing, is typically summarizing some of the ratios that we studied, and they call them key indicators and comparative indicators. These are the ratios that institutions are compared against other institutions to determine whether they are competitive. Let's talk about the size of the institutions. Again, we find that fact that the larger the institutions that have higher assets, size is measured by total assets. Assets are loans, securities, cash, fixed assets, etc. As you notice, the fact that most of these ratios are divided by assets to arrive at the percentage. We find the return on assets, which is net profit after tax, and return on equity are higher, relatively speaking, for large institutions compared to small and mid-size. So the larger the institution, higher the relative ratios. Okay. So this particular chart explains to you the relative ratios for small institutions, mid-size, as well as large institutions. So that pretty much concludes this particular chapter. We will now go to the problems. I will be using the visualizer to display the 2 problems at the end of the chapter. Okay. Before I go through the 2 problems, I wanted to point out to you in the chapter where these equations that we studied are reflected. Please note that beginning with page number 171, the equations are all outlined. These are the ones that are also in your slides. Please remember the fact that we did cross out the 2, which is appearing as a square. In fact, that 2 is footnote number 2 at the bottom. So please make sure you X out in your slides the 2. We only divide that by total assets. So we studied equation number 5. Remember, we are going to look at a different equation for ROE. So ROA, net interest margin, net non-interest margin, net operating margin on page 171. The next equation we studied was earnings spread, page 172. The ROE, return on equity, which was using this equation, please. And again, these are just expansion of each one of these components. So as long as you are comfortable with equation number 11, and if you don't feel comfortable with that, you can use equation number 12 if you feel that this is more something that you would preferred. This is the way that ROE should be calculated, not using the equation that is on page 171. We then studied two additional equations on page number 174. One of them was the net profit margin, number 15, as well as the equity multiplier, 17. So, let's look at the first problem at the end of the chapter. What I have done here is I have outlined the solution, and I will go through this with you so you can follow through, please. First, I wanted to display for you the problem itself. On page number 193, there are two problems. 3 and 4 are the ones that we will study. Please ensure that you know how to solve these without referring to your notes, because you are required to know the formulas by memory. The first problem is explaining to us what the equity multiplier means. If you recall, the equity multiplier was studied on page number 174 rather. The equity multiplier is simply taking total assets divided by total equity capital. So we will practice that first in problem number 3. So the problem reads as follows. The author is saying that there are two banks. One of the banks is called the Oriole Savings Bank, and the other bank is known as the Cardinal Savings Bank. The author is telling us that the equity capital ratio for Oriole is 9%. Now, equity capital is calculated by simply taking total equity capital given to you, please, in the problem, divide that by total assets. Now, if the ratio is 9% given to us, assuming the fact that we have $100 of assets, in order for the result to be 9%, the capital must be $9. And therefore, 9 divided by 100 is 9%. So this is the relative percentage here. Of course, the bank's assets are much more than $100, but to calculate the dollar for every $100 of assets, this ratio is interpreting and telling us that this bank has $9 of capital. Please note, the higher the capital, the better. The lower the capital, the worse. On the other hand, the Cardinal Savings Bank has a capital ratio, equity capital ratio, of 7%. This bank has 9%, this one has 7. Remember, higher the better. The equity capital ratio, higher the better. The equity multiplier ratio, the lower the better. If this is high, EM will be low. If this is low, EM will be high, and we will calculate that. So, in this case, the equity capital ratio is 7. So, for the same $100 of assets. This bank has only $7 of capital, while this bank has capital of 9. So again, this is total equity capital divided by total assets. So for the same amount of assets, the bank that has less capital is more risky. And we will prove that. So Cardinal Savings Bank is more risky than Oriole. The author is asking us, please calculate the equity multiplier ratio. Equity multiplier ratio, please, is the inverse of that. It is total assets divided by total equity capital. So we move this up and we take this as the denominator. Therefore, given $100 of assets and $9, 9% equity ratio, $9 of capital, the equity multiplier is 11.11. Please note this is a relative ratio. It is 11.11 times, not a percentage. What this means is that for every $1 of capital, the bank has $11.11 of assets. And that's what this ratio represents. For every $9 of capital, the bank has $100 of assets. For every $1, it is $11.11. So the bank has invested in $11 of loans and securities, which earns revenue for them, for every dollar of capital that they have. Let's take a look at Cardinal. Cardinal, on the other hand, has $7 of capital, and therefore, to calculate the equity multiplier, we will reverse this equation, and therefore, the equity multiplier ratio is 4.29 times. What this means is that Cardinal Bank, on the other hand, for every $1 of capital or equity, which is a cushion, they have invested $14.27 compared to $11 for Oriole. The bank that has invested significantly higher dollar amount, given the same $1 of cushion, is known to be highly risky. Means they don't have sufficient capital to support that. And the perception and the presumption that regulators have is that in order for Cardinal Bank to invest so much money in loans and securities for $1 of capital compared to this bank having invested less, means this Cardinal Bank is giving out loans to people, customers that are highly risky. And they are investing in securities that are risky. And that's the presumption, that's the assumption that they make. And therefore, please remember, the higher the EM compared to here, the more risky the bank. The lower the better. The lower the EM, higher the equity ratio. Higher the EM, lower the equity ratio. Very important to understand, please. The next part the author is asking is, if ROA is 0.67%, what is the ROE? That is calculated by simply taking ROA times EM, 0.67 times 11.11 is 7.44. Here the ROE is 0.67 times 14.29 or 9.57. This shows that the return on equity for a more risky bank is higher to the shareholders than OREO. The reality is the fact that we would expect that the higher the risk, higher the return. Lower the risk, lower the return. So that concludes problem number 3. Let's look at number 4. In problem number 4, the author is providing us with an income statement of a bank called Smiling Merchants National Bank. I will display the income statement for you. Next. The ratios that the author is asking us to calculate, and by the way, they are also providing the balance sheet. There are 14 ratios required. We will only study the ones that we have reviewed. So we will study all of these ratios on the left-hand side, which are 7 ratios, as well as equity multiplier is the only ratio we will look at on the right-hand side. The rest are not required. So let's go through those ratios next, please. I will bring up this income statement periodically. This is the income statement provided by the author. This shows the fact that profit and loss statement shows interest revenues, interest expense. The difference is net interest income, subtracting the two. We then have the provision for loan and lease losses as an expense. Fees and non-interest income are $20. So if it's positive, it's revenue. If negative, it's expense. And non-interest expenses are operating expenses, are 17. The difference is the net non-interest income, which is the difference between 20 and 17, and that is a positive 3. When we take the positive 3, by just simply looking at this and subtract the 5, negative 5, we get negative 2. So negative 5 and 3 is negative 2. Then we combine these two items. Plus 10 minus 2 is 8. And then the rest of the problem. So here are the ratios. I have also shown here, please, the equation number on the left-hand side. Okay. The first ratio that they're asking us to calculate is ROE. Remember, return on equity is not net income after tax divided by shareholder equity. That's how other companies calculate that. For financial institutions, we will calculate it this way, like we did in problem number 3. However, we don't have the ROA and EM calculated yet. Okay. Once we calculate those, next, we will then come back to this equation. So we will table this for the time being, and we will calculate that as a last ratio. The first ratio we're going to calculate out of the 8 that are required is ROA. ROA is return on assets. Please note that is net income after tax, not pre-tax, divided by total assets. According to the problem, the net income is 7 after tax. We simply take net income, divide by the total assets that are given to us on the balance sheet in the problem. The total assets are 1010. Please do not square that. It's only total assets. That gives us a ratio of 0.69. Please note that these are percentages. Ensure the fact that you do not reflect that as a fraction. The calculator will give you 0.0069. You must convert that to a percentage. The next ratio we will look at is net interest margin. The net interest margin is simply taking interest income on loans and securities that the institution earns and interest expense on deposits and other loans that they have borrowed themselves where they pay interest. The difference becomes net interest income. So the difference between these two is net interest income. When we divide that by assets, that is known as a margin, and a margin is always a percentage. So let's take a look at the income statement again. In the income statement, the interest revenue, interest income is 56, and the interest expense is 46. When we subtract the two, the net interest income is therefore 10. We simply divide that by total assets. 56 minus 46, which is 10, divided by total assets, and the ratio is 0.99%. Next, net non-interest margin. This is a ratio where we look at non-interest income, not interest income, but fees, which are interest fee revenues, and all operating expenses other than the interest expense. These are salaries, benefits, etc. And the provision for loan and lease losses. Remember, that is the allowance for doubtful accounts in banking. We subtract the three, divide by total assets. Again, referring to the income statement, we find the fact that the non-interest income is 20, non-interest expense is 17, and the provision for loan and lease losses is a 5. So we have revenues as a positive and 2 expenses. When we substitute that in our equation, we find the fact that the ratio is 0.20 negative. This is not uncommon for this ratio to be negative, because typically the operating expenses, which is non-interest expense, and the provision for loan and lease losses, these are expenses, are always higher than the fee income. So it is common to have this as a negative ratio. Next one. Now we're looking at the net operating margin. The net operating margin, please, is looking at all revenues. So if you look at these two equations, 6.6 and 6.7, we are combining these two equations to arrive at the result here. So we are taking the interest income from this equation and the non-interest income from this equation. Combined, that's why it's in brackets. We are also bringing in all the expenses, interest expense, as well as non-interest expense and provision for loan and lease losses. So all three of them are combined here. These are the expenses, these are the income, divided by total assets, and the calculations show that the ratio is 0.79. Notice, by the way, that this simply combining these two and we arrive at net operating margin, and this is before tax. The only expense that is not included so far is income tax. This was 0.99 positive. We have negative 0.2. When you combine the two, we get 0.79. In the exam, please make sure if you're asked this equation, just do not simply take the two results and subtract them. You must show this equation. Very important. And then do the calculation. The next equation is earnings spread. This is probably one of the more difficult ratios to calculate. The earnings spread is looking at the efficiency by which the management of the institution is earning interest income on all of the assets that earn interest. Please note, here we'll only look at the earning assets, not total assets. So far, we've been dividing all of these equations by total assets. Here we only look at those assets that earn interest. We subtract that against interest expense and only interest-bearing liabilities. So again, coming back to the P&L, the total interest income is 56. The total interest expense is 46. So therefore, the numerator for each of these components will be interest income 56, interest expense 46. We divide that by earning assets, and here we will divide all of those liabilities that incur that expense. And here are all the assets that provide the interest income. Therefore, let's go to the balance sheet. What I'm going to do is point out to you what are the different assets that earn interest. These are the assets, these are the liabilities. Those assets that earn interest are only investments in securities, federal fund loans, which are loans that banks provide to each other, as well as net loans that are to other customers. These are the three that will earn interest. Please do not include cash and deposits due from banks, because these are liquid cash. They do not invest these. These are almost like accounts receivables. They haven't received them yet. Please also do not include net fixed assets. They do not earn interest. So the only items that you should include are investment securities, federal funds sold, and net loans. Loans that this bank gives to other banks are called federal funds sold. On the other hand, if this bank is borrowing loans from other banks, which is just the reverse, they are known as federal funds purchased. Purchased means loans that they take on themselves, that they have to pay interest expense, and federal funds sold means loans that give to their other banks, where they earn interest. So that's why this is an asset, this is a liability. The other liabilities that will be included as earning, as interest-paying liabilities are savings deposits. These are money market savings. They pay interest. Time deposits are certificate of deposits. They pay interest as well. And federal funds purchased. Please do not include the equity capital. That is not a liability. And demand deposits are not included either. Those are checking accounts. Majority of the checking accounts belong to businesses, and they do not earn interest by law. So banks are not allowed to pay interest on checking accounts that are held by businesses. Banks do pay interest on checking accounts that you and I may have as customers, individuals. But because we don't have the breakdown and majority of the deposits belong to businesses, for the purpose of this class and this course, we will assume that demand deposits, which are known as checking account deposits, are not interest-paying deposits. So we will exclude those. So taking those items here in our equation, we are going to include 150, which is the securities, investment in securities, federal funds sold, and then net loans. The total of the denominator is 860. The interest earned on this 860 is 56. On the liability side, we have savings accounts that pay interest, money market, time deposit accounts, which are certificate deposits, they pay interest, and federal funds purchased, means loans that my bank received from other banks. All of these incur interest expense for the bank. When we divide the two, 56 divided by 860 is 6.51, 46 divided by 730 is 6.30, and therefore the earnings spread is 0.21. Probably the most difficult. You'll be given a balance sheet as well as the information about the income statement. Your job will be to identify only those items that should be included in the denominators, as well as the interest income and interest expense. The next ratios that we will look at are net profit margin. The net profit margin, formula 15, is net income after tax divided by total operating revenues. We know the fact that the net income after tax is $7 million, and the total operating revenues, by the way, is interest income and non-interest income, which is 20. So these are the two positive numbers, interest income and non-interest income, which are fees. We simply divide those two. 7 divided by interest income plus non-interest income will give us 9.21. Equity multiplier. This ratio was studied in problem number 3. This is simply looking at the relative riskiness of the institution. There we will calculate total assets divided by total equity capital. Please remember, lower the better. Means lower risk. Lower means lower risk. Here we have assets of 1,010,000, and the total equity capital, which is given to you in the balance sheet, is 90, and therefore the equity multiplier is 11.22. Finally, we have the equation that we left out earlier, and that is ROE rather. Return on equity is calculated by taking ROA times the equity multiplier. The ROA is calculated as 0.69. We will simply bring that times EM. The equity multiplier was just calculated in this equation as 11.22. We simply multiply the two, and the return on shareholder equity is 7.74. So these are the 8 equations that we are required to know in this particular chapter. Before we end this lecture, I wanted to point out to you that depending upon the textbook version that you are using, whether this is a soft cover textbook, some of you will be using a hardcover textbook or an international version of the textbook. Please note that in the other versions, not in the soft cover, in any of the other versions, there are some typos. The total assets are incorrectly typed in by the author. Please make sure you change that to 1010. The total liabilities are 920. And I'm going to zoom this in so you can see this very clearly. The total assets should be 1010. It is incorrectly identified in your textbook. The total liabilities are also incorrect in your text. It should be 920, and I believe it is 900. And equity should be 90. In some of the textbooks, this is 80. If you add these three items that make up the equity, you'll notice the fact that that is 90. And 920 liabilities plus equity gives us total assets, total liabilities and equity. So assets equals total liabilities and equity. This information, 650, is simply giving you some breakdown of those deposits that are paying interest. This provides you with all the assets that earn interest. We just calculated this 860. So that pretty much concludes the chapter. Please make sure the fact that you review these equations and you are totally familiar with these for the purpose of the exam.